Today's class is about portfolio revision. The syllabus to be covered under this module has been given in the slide. So today we'll be discussing what is portfolio revision, the need for portfolio revision, what are the factors affecting portfolio revision, and the different portfolio revision strategies. We'll also be discussing about the formula plans such as constant rupee value plan, constant ratio plan, variable ratio plan, and rupee cost averaging. So let's start. So what is portfolio revision? See, it involves changing the existing mix of securities. So you're going to change the mix of securities in your portfolio, and that is known as portfolio revision. Now, in order to carry out portfolio revision, you could either change the securities that is currently included in the portfolio, or you can alter the proportion of funds invested in the securities. That is, you can change the type of securities or the companies whose securities you purchased. You purchased a particular securities, a particular company's security, but later on you want to sell it off and purchase another company's securities. That involves portfolio revision. Now you want to change the proportion of investment in the funds. Suppose your total investment in equity funds was 60% and in debt funds was 40%. You now wish to change that proportion. You wish to reduce the percentage of investment you made in risky securities like equity shares, and you wish to invest more in secure investments like debentures or bonds. So you could change the proportion of funds, or you could change the type of securities. Now, so we can say portfolio revision includes adding new securities or removing existing securities. So you will be purchasing and adding new securities to your portfolio, or you will be selling off and removing the existing securities in your portfolio. So we can say that portfolio revision leads to purchase and sale of securities. Now, what is the ultimate aim of portfolio revision? The aim is the same as that of portfolio management. It is to maximize the return for a given level of risk, or to minimize the risk for a given level of return. So maximization of return and minimization of risk is the ultimate goal of portfolio revision. I hope that much is clear. So what is the definition? Portfolio revision may be defined as the process of adjusting the existing portfolio in accordance with the changes in financial market and the investor's position, so as to ensure maximum return from the portfolio with the minimum of risk. So it's the process whereby you will be adjusting your current portfolio according to changes in the financial market and the changes in the investor's position. And your ultimate aim is to maximize return and minimize risk. So that process is referred to as portfolio revision. What is the need for revision? See, once you have created a portfolio for yourself, the need for a change arises when there's a change in the financial market or there's change in the investor's position. What do you mean by change in the investor's position? Maybe the financial status of the investor changed, or his financial preference changed. Maybe he does not have income as he used to have, or maybe he has more income than what he used to have. So depending upon the change in his financial status, his preferences will also change. Maybe he'll be more willing to take up risk, or he will be unwilling to take risk in his present situation. So when the investor's position change, or when the financial market changes, there will be a need for portfolio revision. So some of these situations are explained below. There's availability of additional funds for investment. An investor got additional funds for investment. Then he can buy more securities and add it to his portfolio, and thereby engage in portfolio revision. There's a change in the risk tolerance. Earlier they were more willing to take up risk, but now they do not wish to take up risk. They want safe, regular investment. So their preference has changed, or their risk tolerance has changed. Then it will lead to a portfolio revision. There's a change in the investment goals. Earlier, the goal was to earn high income within a short period of time, but now their goal has changed. They want to get regular incomes over a long period of time. So, if there's a change in the investment goals, they will adjust their portfolio accordingly so that their goals can be met. The next factor is a need to liquidate a part of the portfolio to provide funds for some alternative use. Now you need funds urgently, so you're going to sell off a portion of your portfolio so that you can raise funds for some other purpose. So these are some of the situations that leads to revision of portfolio. What are the constraints or limitations of portfolio revision? Okay. See, there is one factor that you need to consider is the transaction cost. What is transaction cost? Every time you enter into a transaction, it will incur some cost, right? Like the brokerage, the commission fee, everything needs to be paid. So if you are engaging in portfolio revision too frequently, then it will increase the transaction cost. Every time you will be paying the transaction cost. So if you're having too many transactions, too many sales and purchases for portfolio revision, then the transaction cost will be high. And when the transaction cost increases, the profit that you earn will be subsequently reduced. So transaction cost is one of the constraints of portfolio revision. You cannot engage in too many transactions. You should always have the optimum level of transactions so that you can get proper returns. Second is taxes. See, that is LTCG as well as STCG. Long-term capital gain tax is comparatively less than short-term capital gain tax. So if you're engaging in frequent sale and purchase, every profit that you earn through it will be considered as short-term capital gain or STCG, and the tax that will be charged is higher. In order to come under the category of LTCG, you need to hold that security for at least 1 year. So during that 1 year, you cannot make any sort of a sale or purchase. You have to hold that security and then sell it after the completion of 1 year. Then the tax rate charged will be comparatively less. So if you're engaging in frequent portfolio revision, the tax that will be charged will be high because it will be considered as STCG. That is another constraint of portfolio revision. Third is statutory stipulation. Suppose you have invested in a mutual fund. They will have their own policies. They will have their own rules and stipulations and regulations. So they will follow that only, and that makes portfolio revision inflexible or rigid. Then there is intrinsic difficulty. You see, the entire process of portfolio revision itself is confusing. There are various strategies, and there is no foolproof strategy to portfolio revision. You can just try to make your portfolio more and more efficient by eliminating weak securities or by adjusting your portfolio to meet your own personal goals. But then again, there is no guarantee that by adjusting the portfolio, you will get exactly what you wish to get. So there is this intrinsic difficulty, that is this difficulty of carrying out portfolio revision, of deciding when to buy, how much to buy, what to buy. All this is a bit tough for an average investor. So these are the main limitations or constraints of portfolio revision: the transaction cost, taxes, statutory stipulations, and intrinsic difficulty. So what are the different portfolio revision strategies? I said there are different strategies for portfolio revision. See, which strategy to adopt, that will depend upon the investor's objective, skill, resources, and time. How much resource does he have? How much time does he have? What is his level of skill? What are his objectives? Based upon that, the strategy that is most suitable will be chosen by an investor. There are mainly two main strategies. First one is the active revision strategy, and second one is passive revision strategy. Active revision strategy means they will be frequently engaging in buying and selling of securities. What the people who follow active revision strategy believe is that the securities are mispriced and the decisions taken by the investors are heterogeneous. Everybody has got their own goals. It is not same. Everyone has different expectations, different goals, and the decisions they take will be different. So what they are hoping is that when the securities are mispriced, they will calculate the value of the actual true value of the security, and they will try to make a profit by getting superior estimates than the others in the market. They will use their better estimates to generate excess returns. That is what they're hoping to do. Now, in active revision strategy, the sales and purchase is frequent. The frequency of trading is more. Therefore, the transaction cost will also be high. Now, how is active revision strategy carried out? It is based on analysis of the fundamental factors affecting the economy, industry, and company, and also the technical factors like demand and supply. So they will depend upon fundamental and technical analysis to arrive at decisions on when to sell, what to sell, how much to sell, and also when to buy, what to buy, and how much to buy. They will be engaging in transactions frequently. They believe that the securities are mispriced and therefore they can make a profit out of the situation. The second type is passive revision strategy. They believe that everybody, all the investors have a homogeneous expectations. The market is efficient. They are the followers of efficient market hypothesis. They believe that engaging in take fundamental or technical analysis is fruitless. The market is already efficient, so it's best to buy and hold your security as long as possible. So there will only be infrequent or minor adjustments to the portfolio over time. The transaction cost is very less. Under passive revision strategy, adjustment to the portfolio is carried out according to certain predetermined rules and procedures. These predetermined rules and procedures are known as formula plans. So let's see what are formula plans, and then we'll explain each of the formula plan in detail. See, in the market, the price of securities are fluctuating. So what the investor is expected to do is that he should buy when the prices are low and sell when the prices are high, so that he can benefit from the price fluctuations in the securities market. But what actually happens is that when the price is low, the investor will hesitate. They will be hesitant to buy when the prices are low because they expect that the price might fall further. Or they are of the fear that what if the prices does not move upwards again? What if I buy this security, I will not be able to sell it at a higher price? There are two factors that restrict him when he tries to buy when the price is low. He is expecting that the price will fall further, so he will think, okay, I'll purchase after the price falls down a little bit more. But what actually happens is the price will then suddenly start rising and he will not get an opportunity to buy that security. Or they fear that if they purchase at this low price, the price will not move upwards, so I will not be able to sell it at a higher price and get profits again. Similarly, when the price is high, the investor is supposed to sell, right? But then they will hesitate. When the price is high, they will not sell because they feel that the price may rise further. Let me wait for some more time. When it increases further, I will sell the security. Or they may be able to realize larger profits. That is what they believe. But what actually happens is that they will keep on waiting. They will miss the opportunity. The price will start coming downwards. So we need some mechanical revision techniques or procedures to enable the investor to benefit from price fluctuations in the market. So certain techniques are adopted so that the investors will buy the stock when price is low and sell them when the price is high. These techniques are referred to as formula plans. So what are formula plans? Formula plans consist of predetermined rules regarding when to buy or sell and how much to buy or sell. They have already set the rules. When should you buy? When should you sell? And how much should you buy and how much should you sell? So according to these formula plans, they will require the investor to divide their funds into two portfolios. One is aggressive portfolio. The other one is called the defensive or conservative portfolio. The aggressive portfolio will consist of equity shares, and it is a risky one. The values will keep on changing more aggressively, the value of the portfolio. And the other one is conservative or defensive portfolio, which consists of bonds and debentures, and is comparatively less risky and fluctuates a bit less than the aggressive portfolio. So there are different formula plans for implementing the passive portfolio revision. That is, you will hold the portfolio for a long period of time and make changes only when the formula plan demands you to do so. So there are different formula plans for implementing portfolio revision, passive portfolio revision. The first one is constant rupee value plan. See, under the constant rupee value plan, like I explained earlier, there will be two portfolios for the investor. There will be an aggressive portfolio consisting of equity shares, and there will be a defensive portfolio consisting of debentures and bonds. Now, their aim, see, constant rupee value plan, their aim is to keep the rupee value of the aggressive portfolio constant. Okay, so the value of the portfolio should be kept the same. That is their main target. Now, what happens is that you cannot always make sure that if you have invested 50,000 rupees into your aggressive portfolio, you cannot always keep it at 50,000. It might rise up to 55, might fall down to 52, then again it will rise up to 56. It will keep on fluctuating, right, according to the changes in the market. So what you can do is you can set revision points. The revision point is the percentage change that will require you to take an action. Okay, so the revision plan, maybe you have set it as 20%. So you have invested 50,000 into aggressive portfolio. If the value of the portfolio increases more than 20%, or if it decreases more than 20%, then you are going to take some action by buying or selling the securities as required. So you can set a revision point. Now suppose the value of the portfolio increases. It increases about 20%. That is, suppose, see, for a 50,000 investment, if the revision point is 20%, then the value has to increase more than 10,000, right? So we'll wait till the portfolio value rises up to 60,000 or above. You have invested 50,000 till it reaches 60,000 or above. You are not going to do anything. You're going to hold it. Once the price has fluctuated and increased up to 60,000, then it has increased by 20%. You have reached your first revision point. What you will do is you will sell those extra securities. You have invested for 50,000, you now hold 60,000. So you have earned an excess of 10,000 rupees. So 10,000 rupees worth of aggressive securities will be sold off. And what will the investor do? They will use that money from that sales to purchase securities such as debentures and bonds, and they will invest that extra 10,000 into defensive portfolio. Okay, so they are selling off 10,000 worth of equity shares and using that sales proceeds to purchase 10,000 worth of debentures and bonds, and they are investing it in defensive portfolio. So that extra 10,000 has been shifted to the defensive portfolio. Now again, you hold 50,000 worth of portfolio in your aggressive portfolio. Now what if the value of the portfolio falls down? See, the price has gone down to 40,000 or below. From 50,000, the value is now 40,000. The market value is going down. So once it has reached 40,000, what you need to do is you need to make it 50,000 again in the aggressive portfolio. So what will you do? You will sell securities worth 10,000 from your defensive portfolio. Debentures and bonds worth rupees 10,000 will be sold off, and that money will be used to purchase more securities. So 10,000 rupees worth of securities will be purchased and invested in the aggressive portfolio. And again, the aggressive portfolio's rupee value will become 50,000. So when the value increases, they will sell the securities and then they will invest it in the defensive portfolio. When the value of the aggressive portfolio decreases, they will sell some securities in the defensive portfolio and buy the securities and add it along with the aggressive portfolio. So this plan is predetermined, and whenever the price reaches the revision points, the sales or purchase, whatever it is, the sales and the purchase will take place automatically. So it's comparatively a easy and common formula plan. Next is constant ratio plan. Under the constant ratio plan, they are not concerned about the rupee value or the value of the portfolio. They are only concerned about the ratio of the investment in the aggressive and defensive portfolio. What this formula plan aims to do is they will try to keep a certain ratio between the aggressive and defensive portfolio. And they will maintain that predetermined ratio throughout the life period of the portfolios. Suppose the ratio is 1:1, then they are going to do everything to ensure that the aggressive and defensive portfolio always contains funds at equal amounts. Suppose 50,000 has been invested in aggressive portfolio and 50,000 has been invested in defensive portfolio. We have set the ratio as 1:1. Okay. So right now it is 50,000 is to 50,000, which is 1:1. But then suddenly the the aggressive portfolio's value increased and it reached to 52,000. So now we are holding 52,000 worth of portfolio in your aggressive portfolio and 50,000 in your defensive portfolio. So the ratio has now changed. It has become different. It is not equal as we decided. So what will we do? 2,000 is the extra fund in the aggressive portfolio, right? It raised up to 52,000. So what will we do? We will sell off 1,000 rupees worth of aggressive securities and purchase 1,000 rupees worth of defensive bonds and debentures. So now both these portfolios will have 51,000 and 51,000 worth of securities. Again, the ratio came back to 1:1. Hope that example is clear. Our ratio was to always keep it equal. Maybe the ratio will be different also. Maybe it's 1.5:1 or it could be 1.2:1. That is depending upon the investor's decision. The purpose of the plan is to keep the ratio constant by readjusting the two portfolios when the share price fluctuates from time to time. Now, revision points may be set. You cannot keep on constantly revising it. So you can wait for the revision points. Maybe it is 1.2. If the portfolio's value fluctuates more than 0.2%, then more than 0.2, then you can sell or buy and make it according to the predetermined ratio again. So revision points are set in constant ratio plan also. The third one is variable ratio plan. See, instead of maintaining a constant rupee amount in the stocks or a constant ratio of stocks to bonds, like we discussed in the previous two formula plans, the variable ratio plan user steadily lowers the aggressive portion of the total portfolio as stock prices rise and steadily increases the aggressive portion as stock prices fall. By changing the proportion of defensive aggressive holdings, the investor is in effect buying stock more aggressively as stock prices fall and selling stock more aggressively as stock prices rise. So they do not expect to keep the money value of the portfolios constant or to keep the ratio between the two portfolios the same. What they plan to do is that buy when the stock prices are falling and sell when the stock prices are rising. They steadily lower the aggressive portion of the total portfolio as stock prices rise, right? When the price is high, sell off the aggressive portfolio as much as you can and invest that money in the defensive part. And when the prices are falling, it's best to sell some securities in the defensive portfolio and buy the securities that come under aggressive portfolio. So there's a variable ratio plan. Last one is rupee cost averaging. That is another one of the formula plans. So what is rupee cost averaging? It is an approach in which you invest a fixed amount of money at regular intervals. This in turn ensures that you buy more shares of an investment when the prices are low and less when they are high. See, this can be explained with the help of an example as shown in the figure. This figure has been taken from the internet, okay? So you are going to invest a fixed amount at regular intervals. So the first systematic SIP stands for Systematic Investment Plan. Okay. In the first month, the regular period could be either months or weeks or years. That is depending upon your investment plan. Now, suppose you're an investor who's investing rupees 1,000 regularly every month. The first systematic investment plan, you invested 1,000 rupees and you were able to buy 2.8 units from the market. The cost per unit was 1,000 rupees that you invested divided by the 2.8 units. So you will get 357.14 was the cost you paid for one unit. Second month also you invested 1,000 rupees. But at that time the price was high for the security, so you were able to get only 2.1 units. So what was the cost per unit? 1,000 divided by, not 1,000, sorry, you now hold 2,000 worth of securities, right? So 2,000 divided by 2.8 units plus 2.1 units that you hold. So the cost per unit of the portfolio that you hold now is 408.16. In the third month, you again invested 1,000 rupees. At that time, the market was performing low. You were able to purchase more securities at less price. So you were able to get 3.5 units. So what is the cost per unit in your portfolio? You now hold 3,000 rupees worth of securities divided by 2.8 plus 2.1 plus 3.5 units, the total number of units that you hold. Total value by the total number of units that you hold will give you 357.14. See, even though in the second month we had to pay more and get less units, we compensated by in the third month by paying less and getting more units. So when you take the average, you're going to get you'll be able to maintain a certain level of your security. You would have earned something out of your investments. So again, the price of per unit is 357.14. So that is what rupee cost averaging aims to do. They will regularly invest a fixed amount into stock market, whether the market is performing less or whether the market is performing really well. So it will enable you, ultimately it will enable you to buy more shares when the prices are low and less shares when they are high. So you're only investing 1,000 rupees. When the price was high, you were able to buy only 2.1 units. So you bought less. Now next month also you're investing 1,000 rupees. But the prices were less, so you were able to get more units. So you bought more when the prices was low and bought less when the prices was high. So this is the plan of rupee cost averaging. Now there's another term in your syllabus regarding what is index portfolio and tracking. These are the two areas left under portfolio revision. So what is index portfolio? See, an index fund is a type of mutual fund or exchange traded fund with a portfolio constructed to match or track the components of a financial market index, such as Standard & Poor's 500 index, S&P 500. So what we do is that instead of picking stocks to be part of our portfolio, what we do is that we will copy a market index. Whatever securities is included in that market index, we will include the same securities in our portfolio itself. Whichever companies are included in that index, we will hold the securities of those companies in our portfolio also. So the ultimate expectation is that by copying the profile of the index, the fund, our portfolio will match the performance of the index. So it's a method of passive investment strategy where you will just blindly follow the market index. If more securities are added in the market index, we'll also add more securities. If some securities have been removed from the market index, then we will remove that from the portfolio also. So an index fund track, if your index fund is tracking Dow Jones Industrial Average, okay, that's another famous industrial index, market index. For example, it would invest in the same 30 large and publicly owned companies that comprise that index. It consists of 30 companies. We will also invest in the same 30 companies. Portfolios of index funds substantially only change when their benchmark index is changed. As long as there is no change in the market index, then we are not going to bring about any change in the composition of the securities in our portfolio also. Only when the market index changes, we will change accordingly. That is what is known as index portfolio. Tracking simply means keeping a track of the market index so that you can copy the same changes that is being brought in the market index. If they add more securities, we'll add more securities. If they remove securities, we'll remove securities. So that process is known as tracking. Now, if there's a difference between the market index and the portfolio, market index returns and the portfolio return, that is known as tracking error. We were not able to copy it exactly, so there has been some errors. That is known as tracking error. So these are the main points to be covered under the topic of portfolio revision. I hope this much is clear. Thank you.